Today, we will talk about insider trading and when it is legal. Insider trading involves trading in a public company's stock or other securities by someone with non-public, material information about the company. Insider transactions are legal if the insider makes a trade and reports it to the Securities and Exchange Commission, but insider trading is illegal when the material information is still non-public. The U.S. Securities and Exchange Commission defines illegal insider trading as material information is any information that could substantially impact an investor's decision to buy or sell the security. Non-public information is information that is not legally available to the public. The question of legality stems from the SEC's attempt to maintain a fair marketplace. An individual with access to insider information would have an unfair edge over other investors, who do not have the same access and could potentially make larger, and thus unfair, profits than their fellow investors. The Securities Exchange Act of 1934 was the first step in requiring the disclosure of company stock transactions. Directors, executives, or anyone else who has information or who holds more than 10% of any class of a company's securities are considered insiders by the SEC. Anyone who becomes an insider must file SEC Form 3, Initial Statement of Beneficial Ownership of Securities, within 10 days of assuming an insider role. If an insider makes a transaction, they must file Form 4, Statement of Changes in Beneficial Ownership, within 2 business days of making the transaction. This form serves to notify the public that an insider acted on a security. SEC Form 5, Annual Statement of Changes in Beneficial Ownership of Securities, is required no later than 45 days after a company's fiscal year ends. The SEC requires its filing only if one or more transactions exempted from Form 4 were not reported during the year. Illegal insider trading includes an insider not submitting the required forms after making a transaction. It also includes passing along material non-public information before it is made publicly available. Insider trading is nothing new, it has been going on for as long as stock markets have existed. However, there are some notable recent examples worth mentioning. For example, in 2003, Martha Stewart was charged by the SEC with obstruction of justice and securities fraud, including insider trading, for her part in the 2001 ImClone case. In September 2017, former Amazon.com Inc. financial analyst Brett Kennedy was charged with insider trading. Authorities said Kennedy gave fellow University of Washington alumni Maziar Rezaikhani information on Amazon's 2015 first-quarter earnings before the release. Rezaikhani paid Kennedy $10,000 for the information. In a related case, the SEC said Rezaikhani made $115,997 trading Amazon shares based on the tip from Kennedy. The term insider trading generally has a negative connotation based on the perception that it is unfair to the average investor. Essentially, insider trading involves trading in a public company's stock by someone with non-public, material information about that stock. Insider trading is illegal, but if an insider trades their holdings and reports it properly, it is an insider transaction, which is legal. Here are 4 key takeaways. 1. Insider trading is buying or selling a publicly traded company's stock by someone with non-public, material information about that company. 2. Non-public, material information is any information that could substantially impact an investor's decision to buy or sell a security that has not been made available to the public. 3. This form of insider trading is illegal and has stern penalties, including potential fines and jail time. 4. Insider transactions are legal as long as you conform to the rules set forth by the SEC. Hope this would help. Thanks for watching.